Hi, welcome back. In this session, I want to lay the foundations for what I call investment philosophies. I'll start by describing what I mean by an investment philosophy, how it drives investment strategies, and why investment philosophies might vary across the life cycle, how they focus on different parts of the life cycle. So, what is an investment philosophy? An investment philosophy is a way of thinking about markets, thinking about where they make mistakes and why they make mistakes, and why those mistakes correct over time. Why do you care? Because ultimately, if you're an active investor, you're trying to find a market mistake. And then you're trying to exploit that mistake and make money off that mistake. And to do that, your core mistake, the core statement you made, the core assumption you made about the market mistake has to be right. So an investment philosophy is not a strategy. Buying low PE stocks is not an investment philosophy. So to give you some sense of what goes into a philosophy, here are the steps involved. The first step in developing an investment philosophy is understanding human behavior. Is the mistake you're assuming a mistake at the individual level or is it the group level? The reason it makes a difference is if it's mistakes at the individual level, they can average out. You can have a market that's efficient with investors who are making mistakes in both directions. But if it's a group mistake, it's going to show up as a mispricing. Is it a mistake related to how markets learn? The way we think about markets in a rational market is the market gets information, it reassesses the expectations based on the information. But what if markets are not good at assessing information? They can overreact. If they overreact, they're going to push the price up too much on good news and push it down too much on bad news. Or it could be a slow learning market. That could be a mistake. It could be in how they react to information. Again, overreaction and underreaction. It could be in how markets deal with uncertainty. Maybe human beings are not well tuned to uncertainty, and faced with uncertainty, markets give up. They throw up their hands. So you could argue that maybe market mistakes increase when you face more uncertainty. And one of the things we've learned from behavioral finance is the way human beings react to something depends on how it's framed. Investors can react very differently to the same piece of news if it's framed differently, if the framing of news matters. All of these are, the part and parcel of behavioral finance, but then you have to make a judgment on which aspect of human behavior you think you want to bet on as an investor. Now, by itself, the fact that human beings misbehave, that investors misbehave, is not enough unless that misbehavior shows up as a mispricing. So if you have a mispricing, the question is, can you exploit that mispricing? And an investment philosophy is designed to try to take advantage of the mispricing that comes from a mistake. While all active investment philosophies are built on the presumption that markets make mistakes, the differences across philosophies also reflect differences in how and why they think markets make mistakes. If you think markets are correct for the most part, but that they overreact when new and large pieces of information are released, that's going to lead to a very different philosophy than if you think markets are wrong most of the time and that they underreact to new and large pieces of information. Some philosophies are built on the assumption that markets make mistakes in the aggregate. That leads you to market timing philosophies, whereas there are other philosophies that are built upon the presumption that market mistakes are not in the aggregates in individual companies. Or you might believe markets are pretty good at pricing stocks for the most part, but that they have trouble when there's a substantial, when big news comes out, big good news or big bad news. That leads to a philosophy as well. In effect, every investment philosophy starts with an assumption about human misbehavior. That translates into mispricing, and then that translates into philosophy that you think can take advantage of that mispricing. Once you've developed a philosophy, though, you can come up with investment strategies built around the philosophy. For instance, if you believe that markets overreact, I can give you two different investment philosophies built around market overreaction. Maybe your philosophy is that markets overreact to news that companies release. What will that lead to? An investment philosophy that leads you to buy stocks after good news. Buy stocks after bad news because the price would have dropped too much. And sell stocks after good news because the price would have gone up too much. Alternatively, you can be a believer that markets overreact, but to macroeconomic news. You know what you're going to do then? You're going to buy the entire market after bad macroeconomic news and sell the entire market after good macroeconomic news. What I'm trying to argue for here is you can start with the same belief in misbehavior and end up with two different philosophies. Now, once you have a philosophy and strategies, the question is, what best fits you. I know the way most people pick investment philosophies is they look at who succeeded in the past and they try to do what they did. I mean, that's the only explanation you can have for why there are hundreds of books on Warren Buffett. Everybody wants to be the next Buffett. So what do? They read the book about what he did and then try to do exactly what he did. And it almost never seems to work out. These philosophies that are winning philosophies in the hands of those people don't seem to deliver the same winning for you. And you're saying, why not? One is every successful investment philosophy has a set of personal characteristics and capital access requirements that you might not have. I'll give you an example. The kind of philosophy that Warren Buffett nurtured to make money is built around buying undervalued stocks and waiting. It requires patience. But what if you're naturally impatient? It's going to be tough for you to deliver that. An investment philosophy that made Carl Icahn and Bill Ackman rich was to buy undervalued companies and change the way they run, activist investing. But to do that, you got to buy 5, 10, 15% of a company. But if you have only $10,000 to invest, you can't do that. So one reason those philosophies might not work for you is you don't have the requirements for it to work. The other is there is no one best investment philosophy that fits all investors. There's one that's right for you. And you know how you find it? By learning more about yourself. I tell people that rather than understanding what makes Warren Buffett tick or Peter Lynch tick, you got to understand what makes you tick, what makes you happy, what makes you uncomfortable, because that is at the heart of developing an investment philosophy that's right for you. So the bottom line is investment philosophies take thinking about markets and coming to an understanding of what you think markets do. And what you come to as an understanding might not be a consensus. There might be other people who disagree with you, but you're comfortable with your understanding. It's going to drive the way you invest. Now, with that in background, let's think about why you need a philosophy. I've actually had arguments with active money managers. Why do I need a philosophy? Why can't I just invest? Well, if you don't have an investment philosophy, a core set of beliefs, it opens you up to three possibilities, none of which will have positive effects on your portfolio. The first is you're going to be fair game for every charlatan pretender trying to sell a get-rich-quickly scheme. After all, if you have no core set of beliefs, you're going to fall for everything. Second, your actual portfolio is going to shift from year to year because you're chasing the winners from last year. Your transactions costs are going to kill you. And finally, if you've picked a strategy that works for other investors but doesn't work for you, given your objectives, your risk aversion, your personal makeup, you're not going to succeed with that strategy. So I think that if you're going to become an active investor, you've got to start with a set of core beliefs that you might not know to be the truth, but they are your truth. They will drive how you invest. So to get an understanding of different types of philosophies and how they work out, let's look at the investment process, at least the way it's supposed to work out. It starts with the investor, right? Their risk tolerance, their investment horizon, their tax status. That client might be you. You might work for yourself. You're the portfolio manager. And here's what you're doing for yourself. The first step is you make an asset allocation decision. What's your asset allocation decision? You decide what percentage of your portfolio goes to stocks, bonds, real assets, other asset classes. It is a big part of portfolio management is making that asset allocation decision. What drives the decision? First is your views on markets. If you're a market timer, this is where you will reflect it. You will invest more in those underpriced markets and less in overpriced markets. It'll also be driven by your views about inflation and interest rates and economic growth, macroeconomic variables. So let's say you've come up with an asset allocation judgment, 50% in stocks, 40% in bonds, 10% in cash. Your next stop is to actually pick the individual assets within each asset class. So if you've decided to invest 50% in stock, which stocks are you going to buy? Which bonds? Which real assets? And here you might make either assessments of what something is worth based on cash flows or growth or technical indicators, depending on your philosophy. Or, and this is getting a little close to the line you shouldn't be crossing, maybe information about companies that I would call euphemistically private information. The line between private and insider information is a fine one, and you don't want to cross it. But you try to make picks of which stocks, which bonds, which real assets. And then you execute. What is execution? You go out and buy the stocks you wanted to buy, the bond. And in this process, you got to factor in how often you trade, how large are your trades, because that's going to affect your transactions costs and the speed with which you trade. So you start with asset allocation, you make the choices of individual assets, and then you execute. You're done, right? Not quite. Because if you're being accountable, you got to make sure that the choices you made actually paid off. You evaluate your choices to see if you delivered value. What does that mean? I could have automated the entire portfolio manager's job, put your money in index funds, reflecting your risk aversion. 50% in equity index funds, 40% in bond index funds, 10% in cash. I'm looking to see whether the choices you made with all the work you put in and the cost actually paid off as higher returns. That performance evaluation, I'm judging you both on your market timing skills, your asset allocation work, as well as your stock selection skills. Asset allocation, security selection, execution, followed up by performance evaluation. You could argue that almost every investment philosophy you see out there is built around something in this process. If you're a market timer, either because you value entire indices or because you're a macro market timer, it's really all about asset allocation. Market timers don't try to pick stocks, they try to decide when to get into stocks and when to get out of stocks. The good news is if you can do market timing right, the payoff is immense. But if you're not a market timer, you try to pick the right stocks. And here there's a whole host of different philosophies. You have passive value investors. What do? They look for stocks that trade at low PE and low price to book and have high dividend yields. You have passive growth investors who buy stocks that trade at low PEG ratios. You have activist value investors who buy companies that they think they can change. You have chartists and technicians who buy stocks because they think the technical indicators suggest that these stocks are going to turn around. They all pick stocks with very different views and different philosophies driving their choices. And finally, there are people who don't really make judgments on markets or individual stocks. They try to find mispricing within the market that they can exploit. In its most perfect form, you find the same thing trading at different prices at the same point in time. You buy the cheaper version, you sell the more expensive version, you lock in a profit. That's called arbitrage. You also have people who try to exploit the fact that markets might not react appropriately to information. I call them information traders. We talked about markets overreacting to earnings. These traders come in and try to take advantage of that mispricing around information trading. Every investment philosophy you see out there is somewhere in here, and you've got to decide where your game is. What are you trying to play? Now, if you think about market timing versus stock selection, market timing shows up in the asset allocation component. Stock selection shows up in what you buy within each asset class. And they're very different philosophies, and they represent very different views about market mistakes. While the market goes up and down, you're saying, where does the life cycle come into play? It comes in indirectly. When markets are up, it turns out that the riskiest investments benefit from buoyant, upbeat markets. When markets are down, it's the more mature companies that hold their value better. Do you see how market timing, if you're a market timer, life cycle can come in? If you're a good market timer, you might shift from companies early in the life cycle to later in the life cycle, depending on whether you think markets are going to go up or down. So if you think markets are going to go up, you shift into younger companies. Markets are going to go down, you shift into more mature companies. Easier said than done, but if you can pull it off, you probably can get incredible payoffs. So market timing and life cycle can be connected. The second contrast I want to draw is between investing and trading. Now, in the earlier session on valuation and pricing, I talked about how value is driven by cash flows, growth and risk, and price is driven by demand and supply. In investing, what you're trying to do is value a company and try to find it trading it below that value and buy it and hope that the gap will close. So the key drivers of value are cash flows, growth and risk, and that's what you're betting on. If you're a trader, you buy at a low price, you sell at a high price. You're playing the pricing game. You frankly couldn't care less about value. I'm not going to give you my biases on investing versus trading. I like investing because that works for me, but I understand other people might be much better off trading. But my only advice is, whether you're an investor or a trader, be honest with yourself. If you're a trader, all you care about is demand and supply, mood and momentum, and the tools you use will be to advance that aim. You might use charts and technical indicators and multiples. If you're an investor, you care about value. You're going to do intrinsic valuation. I think many of the mistakes in markets come from people who claim to be traders trying to play fundamentals, and people who claim to be investors playing the trading game. And you could argue that the skill sets you need to be a successful investor are very different than the skill sets need to be a successful trader. That's why I would never, when investors look down their noses at successful traders, I think they're missing the point. If you can succeed with either one, you should be lauded for being a successful market player. But they're very different games, investing versus trading. And there is a link to the life cycle again. In every market, there are investors and there are traders. I think there are more traders than investors, but the mix changes depending on where you are in the life cycle. With young companies, where pricing is the name of the game, it drives everything, it's traders who dominate. It's mood and momentum that causes price changes. As companies mature, the mix will change. You're going to see more investors enter the mix. So you're going to see this mix of trading and investing, but the mix will be very different depending on where you are in the life cycle. If you're a trader, you got to again decide, are you going to trade on momentum or you're going to trade on reversal? Both coexist. On momentum, you're buying the stocks that have gone up the most in the recent past. On reversal, you might be selling exactly those same stocks. You're saying which one has a better basis? The data is actually mixed, which explains why both kinds of investors, both types of traders coexist. In the really short term, there's almost no correlation. And if there's correlation, by the really short term, I'm talking about hours, even daily, it's very mild positive serial correlation. As you go from days to weeks, there seems to be more evidence of reversal, that if you take the stocks that have gone up the most over the last week or the last 2 weeks, more likely to see a drop in the next week or the next 2 weeks. In the medium term, which I define as months, you revert back to positive serial correlation. The stocks that have gone up the most over the last 6 months are more likely to go over the next 6 months. But wait, if you go to years, it goes back to being negative correlation again. So if you take the stocks that have gone up the most over the last 5 years, they're more likely to go down over the next 5 years. You can already see when you look at trading, you're going to get momentum traders and reversal traders in the same market, both hoping to make money. In hindsight, only one of them is going to win, but you can see why they both coexist. And here's the link to the life cycle. Early in the life cycle, as I said, it's all about trading. Momentum is going to be incredibly strong at young companies. If you're doing intrinsic valuation of a young company, you find it undervalued and you buy the company, don't be surprised if it keeps going down even after you buy it. It's going in the wrong direction because the momentum is pushing it that way. What it effectively calls for is some humility in investing. If you're investing in young companies, even if you feel confident about value, don't be surprised if the pricing is pushing in the opposite direction. So when you look at why the life cycle matters, if you have an undervalued mature company and an undervalued young company, the gap might close much more quickly with an undervalued mature company than for a young company because momentum is so strong early in the life cycle. As for trading on information, perhaps the best way to illustrate what you're trying to do is to show what happens in an efficient market. In an efficient market, when information comes out, price adjusts instantaneously. So if it's good news, the price jumps and then it levels off. If you have a slow learning market, when the good news comes out, the price goes up and it continues to drift up. Drift and efficient don't go together. In an overreacting market, the price goes up, but it goes up too much and then it drifts down. So you can already see that, what you think about market reaction information can become the basis for trading. So if it's a slow learning market, what are you going to do? You're going to buy after good news and take advantage of the drift. If it's an overreacting market, you're going to sell after good news and take advantage of the drift down. So let's see what actually holds. And one of the most studied information events of all time is earnings announcements. This is actually from studies of earnings announcements classified by the news in that announcement. The most positive earnings announcements are up there. The most negative earnings announcements are down here. What are you saying? First, look at that's the day of the announcement. You notice that there is a reaction, and the reaction is consistent. With good news, the price goes up. Bad news, the price goes down. So far, nothing there, right? But here's the interesting part. There is a drift here. And studies of earnings announcements suggest that there is a slow learning process, that good news creates a jump, but the jump continues. The price continues to drift up. Bad news causes... Now do you see why traders come around earnings announcements, buying stocks after good earnings announcements, hoping to take advantage of the drift? Before you get too excited though, there is a potential risk here, which is at some point in time, it reverses. And you got to get out at the right time. The essence to trading is getting in at the right time and getting out. And that's at the basis for information trading. So what is the link to life cycles? These studies of earnings announcements have been, when you look at the reaction to earnings announcements, they tend to be much greater. Their reaction to good news and bad news, much greater at small firms than at large firms. At firms where there's more uncertainty about future earnings than at firms with less uncertainty. And remember, in the life cycle, young firms tend to be smaller, have more uncertainty. You could argue that what you saw on that graph as a reaction to earnings announcement is going to be exaggerated at young companies. So if you're an information trader, you're going to be drawn to earnings surprises at the youngest companies in the market because that's where these drifts are going to be most pronounced. Now, the definition of arbitrage trading is you make an investment, you take no risk, and you earn more than the riskless trade. It's a money machine. That's why I talked about two assets which are exactly identical trading at different prices. You lock in that difference, you have no risk. But in the real world, pure arbitrage is really, 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 really difficult to find. And when it's found, it's gone because people take advantage of it. What you're more likely to find in the real world is near arbitrage, where you have assets that are not quite identical, but very, very similar, but they're trading at different prices. You lock in the difference, but it's not guaranteed that the price will close because the differences might cause the price to remain different. And then there is something that you can call speculative arbitrage, where arbitrage might not even belong in the term. In speculative arbitrage, you take two investments that are similar but have significant differences, and you hope that the prices converge. This is a risky investment. You might make money, but it's not guaranteed. So there's pure arbitrage, near arbitrage, speculative arbitrage. Now you're saying again, what's the challenge here? First, remember, if it's not pure arbitrage, the two assets that you're comparing are not quite identical. Those price differences might be real differences that never go away. Second, even if the prices are different and the assets are pretty identical, you might not be, if you can't trade on them, then all you can do is chronicle the price difference, but not much you can do. And third, maybe you can trade on it, but the costs are so large that by the time you expend those resources, the arbitrage profits are gone. So when you see something that's too good to be true, it's often too good to be true. And with arbitrage, it's often the case. Again, let's link up arbitrage to life cycle. First, as I've argued all through these last few sessions, you're going to see pricing errors with every company, but you're likely to see bigger pricing errors at young companies than at more mature companies because there's so much more uncertainty. When you are talking about arbitrage as finding pricing errors, perhaps you can find, if not pure arbitrage, near arbitrage with young companies. And at the very end of the life cycle, when you have distressed companies, you might find near arbitrage by finding multiple securities on the same distressed company, convertible bonds, warrants, and stocks, and traditional bonds trading at prices that you think are not right. But the truth is, with these companies, you're going to face liquidity issues, much higher transactions costs. But here's the escape hatch. If you as an investor can find a cost or an information advantage with very young companies or with these multiple securities by distressed companies, perhaps you can take advantage of it. There are hedge funds, which in fact are hedge funds built around investing in different securities issued by the same company and taking advantage of mispricing, and some of them make money because they've established advantages over everybody else in the market. Now, there are two final components where I want to connect life cycle to investment philosophies. When you think about classic investment philosophies, the two classics are value versus growth. You're saying, what's the difference? The way people classify them in practice by looking at value investors as those who invest in low PE ratio companies and growth investors as those who invest in high PE ratio companies, which is kind of lazy. I actually think you can think about value and growth investors in the context of that financial balance sheet that I introduced quite a few sessions ago. In the financial balance sheet, I said the value of a company comes from assets in place and growth assets. It's funded with debt and equity. The way I think about value investors is value investors try to invest in companies where the assets in place, investments they've already made, are worth more than what you're paying for the company. That's at the heart of the Ben Graham security analysis approach in old-time value investing. Buy something for less than what they have on their books right now. Growth investing takes a very different tack. It says that the real mistakes are made in assessing the value of growth, and we're going to buy companies where the value of growth is greater than what the market is pricing it. Let's face it, both value and growth investors care about value. The difference is where they think the mistakes are made. Value investors believe they can find mistakes in assets in place. Growth investors believe that those mistakes are more likely to be in assessments of how much growth is worth in the future. Another big contrast drawn in investing is the contrast between activist and passive investing. Not activist, but activist. In passive investing, you buy a stock and then you pray that the price moves towards a value, whether you're a value investor or a growth investor. In activist investing, you take a stake in a company and then you try to change the way the company is run. I'm going to argue that the balance between activist and passive investing will depend on where you're in the life cycle. Very early in the life cycle, you know where you get your investors, right? They tend to be venture capitalists. Venture capitalists almost never are passive investors. They take an activist role. They want to change the way the companies run because they want to cash out. As companies move through the life cycle and become more mature, you're going to see activist investors being replaced by passive investors. So the mature companies, you're more likely to get institutional investors. They don't like the way you run. They just sell and move on. They vote with their feet. And then you get into decline. Activists come back again as private equity investors and hedge funds trying to change the way the companies run, breaking it up, and liquidation. So the degree of activism you're going to see among the investors is going to shift depending on where you're in the life cycle. So I hope you get a chance to think through what your beliefs about markets are and what kind of investment philosophy is right for you. And then think about how that works out in terms of where you will end up in the life cycle. As I argued at the start, there is no one best investment philosophy. There's one that's right for you. And whichever investment philosophy you pick will lead you to one part of the life cycle or the other. And that's perfectly okay, as long as you recognize that that's happening. I hope you found this session useful, and thank you very much for listening.